This is Money Made Simple, the financial podcast that keeps it simple and gets to the point.
Welcome back to Money Made Simple, brought to you by Simplicity. Today I have a very special guest with me. Joining me on the couch is Robbie Paul from Icehouse Ventures. Welcome, Robbie.
Great to be here. Yeah, thanks.
Can you tell me a little bit about your background, where you come from? It doesn't sound like you're from New Zealand, right?
I grew up in North Carolina, which is on the east coast of the U.S. I'd studied abroad in New Zealand and moved here in 2008. And I had a one-year work visa, convinced Icehouse at the time to take me in as an unpaid intern, and then convinced the government to give me a one-year visa again, and then got residency and citizenship and Kiwi kids and English wife, actually. But this is our home.
Nice. So tell me about your involvement with Icehouse. Were you involved with them from the start, or how did Icehouse even start before you joined them?
Sure. I joined in 2008. The original Icehouse started in 2001, and it came out of a partnership with the university and a few other groups, and they wanted to build programs for owners of companies that are based in New Zealand to help them upskill. Then an incubator was founded in 2003. So an incubator is, in a traditional sense, like a physical space where fledgling entrepreneurs come in and they get support and coaching and community and so on. And Icehouse was one of the providers of that and worked with startups. In fact, one of them from the earliest days was the wireless power company, Power by Proxy, which came through the university. Nobody knows that name, but everybody uses their technology even to today, which is any inductive charging on any Apple products. So if you've ever charged one of your headphones or watches or phones without plugging it in, you're using technology that's still designed in Wynyard Quarter. And billions of devices around the world are, still designed by Power by Proxy with inside Apple.
So Icehouse originally helped incubate that company?
Correct.
And tell me about the angel investing side of it.
Yeah, a logical extension of an incubator, if an incubator is producing fledgling startups that need capital, is to try to bring capital around them.
Okay.
Angels, that term came out of something called the Broadway Angels, which were individuals that were funding the creation of Broadway shows. And then the idea of that model got extended to business angels or angel investors. And that is individuals who are high net worths choosing to invest their own money into fledgling startups, typically software, hardware, medical devices, anything that
tech.
Is tech and can go global. So we formed the first angel network. There was 5 founding members in 2003. By the time I arrived, that network was about 30 members in 2008. It had invested in 11 companies.
And how has it developed since then? Is that kind of still the core of Icehouse Ventures business?
Investing in venture companies or technology startups is the core of the business. So our mission is to find and invest in the most promising entrepreneurs that come out of this country and the most promising Kiwi founded companies anywhere on the planet. The angel network has evolved to be just more of a community that is attached to our funds. Our core business, or the primary way that we can provide capital to companies, is by raising money into managed funds, where investors commit money to us based on a specific strategy or mission. That money gets pulled into a fund and then gets invested over a sort of 3 or 4 year period.
So let's take a little step back. And for those kind of new or less in the world of investing, can you kind of describe to me what venture capital really is? And then how does that differ to private equity? They're quite different, right?
Yeah, they're both providing capital to companies in various forms to help them grow. Venture capital, fundamentally, you have the foundation of an idea, so that you've got the seeds there, right? The next thing that an entrepreneur needs is to start building a company and building their technology. And if they don't have cash themselves, then they would go to an investor and ask for that cash. And obviously, they couldn't go to a bank because they have no assets, they have no revenue. And while there are some grants, they tend to be tied to whether or not the company already is in existence. So you have this sort of chicken and egg thing. Yep. Enter venture capital, where an entrepreneur can say to a group like Icehouse Ventures, and there's lots of different firms like us, hey, I want to test this idea and see if I can build it into something, and I need X amount of dollars to do so. And if you're willing to put this money in, then I'll give you shares in my company. And if all our dreams come true, those shares are going to be worth a lot of money. So will you take that risk?
Yeah, so that's that value exchanges for potential future success.
Correct. And in venture capital, to be very clear, the entrepreneurs are flying the plane. We are not telling the entrepreneurs how to build their business. We are there to support them, but we invest only when we have high conviction that they've got the intellectual capacity and drive and everything else to really build something of consequence.
Okay. So describe to me what private equity is then. You've talked about venture capital and that kind of seed of an idea and needing the funding to then ramp them up. And obviously for that, you get a stake by funding that.
A key difference is that private equity tends to buy ownership stakes in established companies. Private equity tends to do best by finding companies that are established, growing, but have the foundations to become bigger and more optimized.
Okay, so already successful, but want to scale up further in some way.
Correct. And a recent one that I think most people will be familiar with that's private equity backed is AS Color. Okay. So this is not a concept like, can you make a t-shirt or not? They can do that, and they've been doing it very successfully for a long time, including winning in the US. And so recently there's been an announcement of a new private equity investment. And obviously those private equity investors are coming in saying, well, you've done great, but I think you can become even better, and I want to be part of that.
Right. Cool. And so Icehouse is very much in the venture capital side rather than the private equity, right?
The short answer is yes, except that you can't always delineate between stage. So this year we invested in Crimson. It's hundreds of millions of dollars in revenue. 10 years old, cash flow positive,
so
right?
It could have been described as a private equity type of investment.
It fits within the stage. This is where it gets nuanced, because most private equity funds will buy majority holdings, right. But when it's raising venture capital, the founders are still very much in control. They're not selling shares. They're bringing new money into the company, and they're using that money to try to compound their advantages.
Okay. So it's not about necessarily just the stage and establishment of the company. It's more around the way that those shares or the stake is being acquired.
Yeah, that's right. And it's nuanced.
So tell me about the startup environment in New Zealand. Do you think it's healthy? Is it well supported? Has it changed much from the last, say, decades?
It's so vibrant, and it's changing fast and getting better by the day. So at a high level, I'm extremely bullish, and I just think there's so many proof points. We are in a better place than we've ever been. Entrepreneurs, no matter the markets or the people in power or whatever geopolitical risk, they're starting companies and they're building companies, and they're not stopping.
And why do you think that it's even better than it's ever been now? What has caused that positivity and potential growth?
Entrepreneurs breed entrepreneurs. And so where was the founder of Halter working before he started Halter? At Rocket Lab, right? And where was Peter Beck working? At a technology company that was a startup at a time. Meanwhile, if I told you a decade ago you could sell a company on Zoom, you would have not believed me, or that you would have hired somebody that you've never met in person, or that you could raise money from a US investor while being a New Zealand limited company. It wouldn't have been possible. All of those things are changing, and there's lots of sort of both mindset and technological evolutions that are disproportionately benefiting New Zealand, because if you're remote, you have disadvantages. And if the idea of remoteness disappears, you get a bigger swing from whatever your disadvantages are to what the level playing field is.
Okay, so three things there really is that there's almost a snowball effect of as there's more entrepreneurs, there's more people that will be influenced by that, whether it be in the family or their circles. Globalization is obviously a really big one, and that's really advanced in the last 10, 20 years. And then technology, obviously, the likes of Zoom. I mean, AI, I'm sure, will have a huge impact on it all. That's kind of, I guess it's giving the whole venture capital industry a snowball effect. But do you think it's harder for New Zealand entrepreneurs to access capital than it is in, say, some other more advanced markets?
Not at all. And I just want to state that very clearly, because that's been a narrative that's been overplayed for 15 years and never been true. And I'll give you just like one anecdote. 2011, Vinod Khosla, the billionaire founder of Sun Microsystems, comes down here. He's down here because he invested in Rocket Lab and LanzaTech. If you're of the right pedigree, you can raise money. That was true in 2011 and is way more true today. Now there's like every month an international VC investing in this market. The other part of the capital stack that I don't think people can really appreciate is the growth of KiwiSaver. And the reason is, as a KiwiSaver grows, if you just look at international standards, so too can its allocation to unlisted or high growth assets, right? If you have $1 billion under management, maybe you would allocate 2%, so 20 million to unlisted high growth assets. And I know this isn't simplicity policy, but just illustratively, if you get to 10 billion, you could allocate like 10% because you can set more aside. Now, what's the difference between 2% of $1 billion and 10% of 10 billion? It's 50 times.
I wasn't going to do the math there, but
it's 20 going to $1 billion.
Yeah.
And so the amount of capital that could be available to growth companies in New Zealand is insane over the next decade.
It's all about scale, right? Just coming back to how Icehouse actually operates and invests, tell me about how that goes for, say, a Kiwi entrepreneur. So would an entrepreneur come to you with kind of like a business case, and then there would be a whole lot of due diligence done by your team, or how does that kind of work?
Yeah, that's right. The starting point is, an entrepreneur needs to be able to articulate some sort of mission that they've got, and then at the earliest stages, they'd have very little substance. There's no past revenue, there's no technology, there's no IP. And so really all you're trying to do is just test hypotheses and test the intellect of the founder and the clarity and the alignment. So for us, we can afford to take risks for two reasons. One, because we're never betting the farm, not even close, right? Like the typical investment that we'd make in a really early stage company is maybe 100,000 or up to $1 million, depending on the situation and the conditions. And we have $1 billion under management. So the key question always is, what matters more, that this company valiantly tried and failed, and we lost 0.001% of our investment, or as a result of taking a brave bet early, this company, which we invested in, doubles and makes up for 4,000 of its peers.
So do you have like a percent, because I'm sure everyone wonders, in terms of VC, the amount of companies or startups that fail versus those that succeed?
We've invested in 376 companies. Keep in mind about 150 of those in the last 4 years. But taking that into account, 82 companies have failed, 35 have delivered positive returns. That still leaves sort of 220 companies live and operating. And within that 220, some are going absolutely stunningly, some are going terribly, and some we don't know yet. And the common narrative is 9 out of 10 fail.
Yeah,
and
absolutely.
But I would reframe it to say 1 out of maybe 100 become extremely consequential. And that's what matters. My second fund we raised was 1.1 million in 2014, and we invested in 10 companies. It was 11 years. 8 are still going. Right.
That's good. That's definitely not that 90% of failure.
That's right. And so are all of them going to send shockwaves across the world and become the next NVIDIA? Probably not, but they're still good companies. These things take a long time. Yeah. We're very patient in that regard, and we know that there's twists and turns, and eventually some companies can really thrive.
So that mentorship side of the business still exists. It's not just about the investment.
That's right. Not in a traditional incubator sense, but yeah, we want to stay very proximate to the companies. I would describe the company's needs as two things. One is really bespoke set of questions that need to be answered. Like, how do I sell to ranchers in Wyoming? A question that Halter would have, or like, how do I get through FDA for a medical device? Those questions need to be answered by people in the industry. And our goal is to find those people in the industry.
Connecting.
Yeah. And then there's questions that every company has, whether or not you're doing fusion energy or fintech, like, how do I set up an employee share option pool? If I'm flipping into the United States and I need to set up a Delaware C Corp, how much do I pay a chief revenue officer? What does a good board pack look like? What should my valuation be? And we want to be able to answer those with data. And I think we can really lean in. And then I think the most impactful way you can support companies is enabling founders to learn from each other, because often they're just a couple of steps ahead of their peers. So they're feeling the pain and they have real and relevant and recent experience.
Okay, so you're kind of fostering that community of entrepreneurs and success stories and growing, learning from each other. So have you seen a lot more institutional investors like Simplicity investing more in venture capital? Are you seeing more of that in the last few years or the last decade?
Definitely. I mean, I think Simplicity sort of loosened the jar lid, and now across the board, large institutional sort of advisors and wealth managers, KiwiSavers, other managed funds, Kiwi, you're seeing a lot more participation in this space. I think it's starting to compound because there's more and more funds that have been backed by more and more managers. And so people are sort of learning and evolving.
So it's, again, that's like kind of like that snowball effect of as some start and then more understand where the risk versus return is, and then it gets bigger and more accepted, I guess, as the startup industry gets stronger and stronger.
Totally. I mean, it was inevitable. It just has to take time.
You've talked a bit about Halter. Is there any other standout startups that you can provide as an example of success that Icehouse has helped in the New Zealand market?
Oh, there's just like so many amazing companies in this country, and we're lucky to have funded a lot of them from sort of all different walks of life. I mean, Dawn Aerospace, people would probably have seen it in the news as like this space plane that is very cool to look at. But actually, they have a very large business in propulsion systems for small satellites. Most people don't realize that satellites have gotten smaller. And just think about this in your home. What did your computer look like, 20 years ago when it was sitting on a desk? And how powerful was it? And what does your phone look like in terms of scale? There's miniaturization happening and things are becoming more powerful.
Yep.
In satellites, it's the same thing. You used to have to send something like 1.5 tons into space. And then because it costs so much, you can send it up there and you have to have it last for 15 years. Think about how much a phone camera has changed in 15 years. What happened is miniaturization. And all of a sudden, there's satellites that are the size of a toaster sitting in space performing the same function.
That the ton, more than a ton one did before.
Correct. Like the size of this room to the size of a toaster. And those things need to move around in space. And Dawn Aerospace developed the motors for them to do that, and a specific propellant or fuel to enable it. And so now there are hundreds of satellites up there moving around thanks to Dawn Aerospace, designed in Christchurch. And they have this space plane.
Everyone talks about,
And I guess I'd point that out because there's just like a lot of silent successes out there. I mean, these companies are building sort of this invisible infrastructure that makes life better and easier. And when you put your phone on a pad by your bed and it's charging without plugging in, that's this invisible infrastructure that Power by Proxy is built and powers the world.
It's the least sexy side of it, but maybe even more money making or successful side of the startup world, right?
Totally.
In terms of the really big successes that you've seen from Dawn Aerospace to Halter, are there any kind of particular things in common that you see that contributes to their success?
Well, entrepreneurs contribute to their success. When you're building a company, you need to convince investors, customers, government, other type of financiers, your family, everybody to just keep giving you a shot to do something really risky and consequential.
So it's not just about a great idea, it's about having the confidence and the resilience and then a strong network around you that actually contributes to that success.
Yeah, and a lot of persistence. You would be hard-pressed to name a company that became really valuable in less than 10 years. I just don't think people should really expect some sort of fairy tale run. And there's these ridiculous graphs that come out and it's like AI, the new thing is now to go from 0 to $100 million in revenue in a year. Obviously, that's fun. But also, there's some great companies that are 15-year success stories. There is economic reward for patience, right? There's also economic reward for taking risk. And there's economic reward for hard work. And there's economic reward for doing all of those at the same time. And so that's, I think, venture capital, right?
Yeah.
You put in some time, have some patience, you take some risk, and you should get outsized rewards for that.
Nice. I was actually just about to ask you any final words for aspiring entrepreneurs, but I think that did it pretty well.
Yeah, it's risk, time, and patience.
I like it. Okay, I think we'll wrap it up there. But thank you so much, Robbie, for giving us a whole lot of insight into that venture capital world and what Icehouse is about. We're stoked to be working with you guys, and long may it continue.
Yeah, thanks very much. Yeah, great to be here.
Cheers. And we'll catch our listeners next time. This podcast contains personal opinions and is intended to provide educational information only. It doesn't relate to your particular financial situation or goals and is not financial advice or recommendations. Simplicity New Zealand Limited is the issuer of the Simplicity KiwiSaver scheme and investment funds. For product disclosure statements, please visit Simplicity's website, simplicity.kiwi.